Silicon Valley Bank. Here's how the second biggest bank collapse in U.S. history happened in just 48 hours. The company's downward spiral began late Wednesday when it surprised investors with news that it needed to raise $2.25 billion to shore up its balance sheet. So they were rebalancing their balance sheet. Notice this difference in assets versus liabilities, $2.25 billion. All told, customers withdrew a staggering $42 billion of deposits by the end of Thursday, according to California regulatory filing. So basically, this ensued a bank run once word got out. Now, those who remained with Silicon Valley Bank faced an uncertain timeline for their retrieving their money. Everything has been frozen, so they are not allowed to get their money out at this time. We're going to go into the All In podcast to get a little bit more detail on what actually happened here, what this means, and how this actually affects crypto, and why this highlights the need for an alternative, Bitcoin, Ethereum, crypto markets. So if that sounds interesting to you, please stick around and enjoy the video.
Yeah, before Freeberg starts with the why, just the what that's happened as well. This all started on Wednesday evening when Silicon Valley Bank's CEO published a letter to shareholders announcing that the bank was rebalancing its balance sheet by selling tens of billions of dollars worth of mostly U.S. treasuries. And then they announced they would raise some money and sell some shares in Silicon Valley Bank. Then the shares in Silicon Valley Bank as a publicly traded entity dropped 60% on Thursday, then another 60% on Friday. Of course, then the entire world got focused on this, and then every venture capitalist started telling, or I would say the overwhelming majority of venture capitalists told their founders to get their money out of SVB. Then you had a classic run on the bank. A small number of venture capitalists gave advice to say, hey, we should support Silicon Valley Bank. I understand that, but it turned out to be really bad advice. And then trading was halted on Friday morning pending news. And then finally, the FDIC shut down Silicon Valley Bank at noon on Friday, and there's a lot of speculation of what will happen on over the weekend. But maybe you could walk us through technically what happened to Silicon Valley Bank and why they had this cash shortfall and this run. We explained the run on the bank basically, but what led up to this?
The irony is, it really was and is, prior to the quote run, a financially solvent business. So I have a few slides. If you're on YouTube, you can see it. That we pulled one slide that was kind of made by us and the other set that come from Silicon Valley Bank's actual presentations. But if you look at their balance sheet, this is from the end of the year 2022, you can kind of look at the stuff that they owe, their liabilities, which is what they owe their customers that sits in deposits. Because when customers give you cash in a deposit, you owe them that money back. So that sits as a liability. And then they had some other debt. So in total, Silicon Valley Bank at the end of the year had about $195 billion in liabilities, $173 billion of customer deposits that they owe to customers and $22 billion of other debt. And then they take those customer deposits and they invest it in a number of securities. And the way that a balance sheet business like this bank would operate is, the customers have access to their cash anytime they want. But in order for the bank to make money, they make longer duration investments. And those longer duration investments give them the ability to earn money on those longer duration investments more than they're paying the customers for the deposit. So if you look at their longer duration investments, they had about $208 billion of total assets sitting on the balance sheet. So compare that to the $195 billion that they owe customers and other debt holders. So, the difference here between 208 and 195 is about $13 billion. That's kind of the net, what people would call book value of Silicon Valley Bank at the end of the year. And of the $208 billion of assets that they had, $74 billion were loans, and they've got a breakdown of the loan portfolio here in a minute. $91 billion were these hold-to-maturity securities, where they don't actually adjust the value of these on a quarterly basis. And $26 billion is what triggered this panic, which is available for sale securities, mostly treasuries. And what happened is Silicon Valley Bank's deposits came in so quickly over the last couple of years that they went out and they bought a bunch of treasuries, with the cash that they got. And the problem is that very quickly, of the $173 billion of customer deposits, they've got $14 billion of cash, and then they've got all these treasury securities they can sell, call it $40 billion. So if 25% of customers said tomorrow, hey, we want our cash back, theoretically, they could just dump those treasury securities, distribute the cash, and give it all back to customers. The problem is if suddenly more than 25% want to get their cash back, well, now they have a problem. And that is effectively what triggers the run on the bank. As soon as some folks think that others might be pulling money out, then everyone rushes to be the first money out the door. And that's what triggers a classic run on the bank. There's a statistic, I think, in the 1920s, there were several hundred banks that had runs every year for almost the entire decade. And this was like a regular kind of occurrence that happened in the 1920s that ushered in a lot of our modern securities laws that are meant to kind of create the necessary liquidity provisions in how these banks are able to operate to make cash available to customers. But what happened is...
So much so, by the way, Freeberg, that they made a movie, It's a Wonderful Life, about a bank run.
So basically, one of the bigger problems that Silicon Valley Bank, they ran into two big problems. Number one is deposit decline, where VCs were not investing new money. And when they were not investing new money and startups were burning more money than Silicon Valley had modeled they would be burning because they thought everyone was going to reduce spend and reduce burn, and they didn't. So deposits were going down while all these startups were burning money. No VCs were investing. So total deposits were on the decline. Meanwhile, their bond portfolio, the assets that they hold on the balance sheet, also declined in value. And I kind of just put a really simple illustration here on why. If you have a $100 kind of face value bond that earns 2%, which is basically where these treasuries were a year ago, and you hold that for 10 years, that 10-year bond yields $122. If the interest rate goes up to 5%, then that bond should yield $163. So the value of the first bond actually goes down by 25% because of the market conditions. That's how significant the value changes with just a 3% change in the interest rates. And that's effectively what happened with that available for security segment of the Silicon Valley Bank portfolio balance sheet. They had this bond portfolio that suddenly got devalued, and they had declining deposits. So when deposits start to decline, you got to make sure you have enough assets sitting on the balance sheet. So they sold a bunch of them, said we're going to raise more money. And at that point, everyone kind of perked their head up and said, oh my gosh.
Okay, guys, so how does all of this affect the crypto markets? So what we're looking at here is Circle's Twitter page. Circle helps businesses and developers harness the power of USDC for payments and commerce. So what they do is provide USDC. They're basically a liquidity provider. So you can see here, Silicon Valley Bank is one of 6 banking partners Circle uses for managing the 25% portion of USDC's reserves held in cash. While we await clarity on how the FDIC receivership of the SVB will impact its depositors, Circle and USDC continue to operate normally. So basically they have 25% of the portion of their USDCs held in Silicon Valley Bank. I don't think anyone saw that a bank being a risk for crypto. But as we can come over here, the transparency of Circle, the stable coins we issue are built to a higher standard. That's why USDC is always redeemable 1-to-1 for US dollars. The Euro coin is always redeemable 1-to-1 for euros. Always. So you can come down in here and see the reserve composition. USDC in circulation, cash at reserve banks, short dates. So basically you have this in circulation, deposits, and then this is what you have backing it. You can see they have only a portion cash at reserve banks, and then they have short-dated U.S. Treasury portfolios is the majority of this, backing the 43.4 billion in USDC circulation. So for this to actually be a real 1-to-1 ratio, you'd want to have actually 43.4 billion backed 1-to-1 dollars for it. So you'd want this whole thing to be dark blue. That's not the case. So they revealed that 3.3 billion was caught offsides in the Silicon Bank bank run. So if they have a total of 43.4, 3.3 was caught offsides, they may lose it. I just did some quick math, and 3.3 of 43 billion, that's about 7.6%. Now, if we come over to the USD coin, this is supposed to be a stable coin now. It's the first time in history it's been depegged. So it's worth less. 1 USDC is worth less than $1. And this is the purpose of a USDC coin, is for it to be backed 1-to-1. So it's become depegged. Now, if you look at here, the average downward spike, I guess you could say, is about 7.6%. So it kind of adds up with this circle, 3.3 billion that's held in Silicon Valley Bank. So you can see how the actual traditional financial system is a risk for crypto. And I think this actually highlights the importance of having a little bit of Bitcoin. Bitcoin cannot be infected by any of this. It's just code. You're not backing your money by anything. If you move to a total Bitcoin standard, you actually won't have a need for US dollars anymore or stable coins. That's the world reserve currency would be Bitcoin. So it's just something to think about. A lot of risk in the market right now, a lot of uncertainty, a lot of high net worth individuals had money in Silicon Valley Bank and they're trying to get their money out. We'll see how the Fed responds. Until then, guys, I hope you enjoyed the video. Stay tuned for more videos to come. And if you would, please like, subscribe, and hit the notification bell to get more updates in the future. Have a good one.